Okay, so the big news everyone's buzzing about, the Sensex. It just blew past 82,000. That was May 18th, 2025.
Yeah, quite a milestone.
And think about it. Back in April, just a month before, it was hovering around, what, 73,000?
That's right.
So that's a jump of roughly 12% in just 1 month. It's pretty staggering.
It is a very rapid climb.
So the big question for this deep dive is what's really driving this surge? And, what does it actually mean for investors, for you listening?
Exactly. It's not just one thing, of course.
Yeah.
There's a whole combination of factors at play here.
Right. It's never simple, is it? But let's try and unpack the main pieces.
We should. So that 12% climb, getting us from 73,000 to over 82,000. It has some specific triggers.
Okay, let's start there then. What were the key sparks for this rally?
Well, one major catalyst was definitely the news around the India-US trade deal. The market reacted very positively to that announcement.
Okay. And did we see that reflected in specific stocks?
We certainly did. Take Infosys, for example. Its stock reportedly jumped something like 9% pretty much on the back of that news.
Whoa, 9% for a giant like Infosys. That's really tells you something of the market sentiment towards that deal.
Exactly. It highlights just how significant the market perceived that development to be.
Okay, so the trade deal was a big factor. What else was fueling this fire?
Then you had the investment flows. We saw really substantial inflows from foreign institutional investors, FIIs.
How substantial are we talking?
Around 26,000 crore. That's a lot of overseas capital coming into the market.
Yeah, that's significant. And what about domestic investors? Were they participating too?
Absolutely. Domestic investment, particularly through SIPs, remained very strong. We saw about 22,000 crore coming in that way.
So consistent contributions from within in India as well.
Right. That steady domestic flow provides a kind of solid foundation. It shows local confidence.
So strong confidence from both abroad and at home. That's a powerful combination. Any other economic signals playing a role?
Yeah, the inflation data was also quite favorable. Came in at 3.16%.
Which is relatively stable, right?
Exactly. Lower, stable inflation generally reassures investors about the overall health of the economy. It takes one potential worry off the table.
Makes sense.
And then there's the technical aspect. The Sensex actually breaking through the 81,500 level.
The technical analysts would have been watching that closely.
For sure. Crossing a key resistance level like that often acts as a trigger. It signals strong buying momentum and can, encourage even more buying.
So it sounds like almost a perfect storm of positive factors hitting all at once: trade news, strong investment, good inflation numbers, and a technical breakout.
Pretty much, yeah. A confluence of really supportive signals.
It's easy to get carried away with the excitement of hitting 82,000, though. To really get a grip on this, maybe we should step back for a second, put this number in a bit of historical context.
That's a really good idea. Perspective is key. I mean, it's kind of amazing to remember the Sensex actually started way back in 1979.
Right.
But just 100 points.
Yeah.
100.
Wow. From 100 to over 82,000. That really puts the long-term growth into perspective, doesn't it?
It absolutely does. It's an incredible journey reflecting decades of economic development in India.
But as anyone who's followed the market knows, that journey wasn't exactly a smooth, straight line upwards. There were bumps, big ones.
Oh, definitely not smooth. The market's seen plenty of volatility. You had major events like the 2008 global financial crisis.
A big dip then.
Huge. And then more recently, the shock from the COVID-19 pandemic in 2020 both caused really significant market downturns.
Right.
But what's crucial, I think, is looking at the market's resilience. Its ability to recover from these shocks and, over the long haul, continue that upward trend.
So the lesson there is about weathering the storms, perhaps, for long-term investors.
Precisely. It highlights the potential benefits of staying invested, maybe even seeing downturns as opportunities rather than panicking when things get rough. That long-term view has generally been rewarded.
Okay, so we've got the recent surge drivers and the long-term picture. Now, let's tackle the million-dollar question, or maybe the 82,000-point question. Is this sustainable? Are we looking at a peak here, or is there more room to run?
That's definitely what everyone's asking. Look, the current momentum has some solid backing. India's GDP growth is strong, around 7.2%. Investment levels, both domestic and foreign, as we discussed, are increasing. And there's anticipation about the positive effects still to come from that trade deal.
So the underlying economic engine seems quite strong.
Generally, yes. Those are positive signs for potential continuation.
But you hinted earlier there might be reasons for caution. What are the potential headwinds we need to be aware of?
Right. While the fundamentals look decent, we do need to talk about valuations. The Sensex's price to earnings, or PE ratio, is currently sitting somewhere between 23 and 24.
Okay, and for listeners, what does that PE ratio tell us?
Basically, it's a measure of how much investors are willing to pay for each rupee of a company's earnings. A higher number suggests higher expectations and potentially higher risk.
So 23, 24, is that considered high?
It's elevated.
Bruh.
I wouldn't say it's in bubble territory, perhaps, but it's certainly higher than the long-term average. It suggests the market isn't cheap, which could cap how quickly it can rise further from here.
Okay, so valuations are something to watch. What else?
External factors. Always important. We can't ignore what's happening globally. Changes in U.S. interest rates, for instance, can significantly impact capital flows into emerging markets like India.
Right, Fed policy is always a big one.
Always. And then you have geopolitical risks. Things like border tensions or other international incidents can easily sour investor sentiment and trigger market corrections, regardless of domestic strength.
Good point. So a positive domestic picture, but we're still plugged into the global economy with its own set of risks and valuation concerns.
Exactly. You need to balance both perspectives.
Okay, so given this landscape, the strengths, the risks, if someone is looking for potential opportunities right now, where should they maybe focus their attention? Which sectors are looking interesting?
Well, looking at recent sector performance gives some clues. The IT sector, for example, has been very strong. It's up about 18% recently.
Wow, 18%. That's significantly outpacing the overall market's 12% jump.
It is, and its PE ratio is also quite high, around 28. This likely reflects that optimism around the U.S. trade deal, thinking about tech exports, plus the ongoing global demand for digital transformation.
So IT has strong momentum, but also maybe getting a bit expensive based on that PE.
Potentially, yes. High growth often comes with higher valuations.
What about other major sectors, like banking?
Banking is interesting. It seems to be showing signs of perhaps relative undervaluation compared to IT. There could be some potential there. We saw SBI stocks, for instance, increase by around 12%, which is more in line with the broader market.
So maybe some catch-up potential in banks.
It's possible. Suggests there might still be value to be found in that space.
Okay. And any sectors lagging behind?
The FMCG sector, fast-moving consumer goods, has been growing much more slowly, only up about 5% recently.
Quite a difference compared to IT's 18%.
A very noticeable difference, yeah.
So just based on that snapshot, it seems like IT is hot, driven by trade and demand, while banking might offer some value play. FMCG may be less exciting right now.
That's a reasonable takeaway from the current trends, yes. IT's got the momentum, banking might have the value angle.
All right, this is helpful context. Now let's get practical. For someone listening, trying to figure out what to do with this information, what kind of actionable advice or strategies should they be considering?
Okay, well, a core principle generally is to focus on quality. Invest in financially sound companies.
Meaning what specifically?
Look for businesses with low levels of debt, a track record of consistent profitability. Think about established players known for financial strength, like, say, HDFC Bank as an example, often cited for that kind of profile.
Right, focus on the fundamentals, not just the hype.
Exactly. And beyond individual stocks, think about how you invest. For many people, starting systematic investment plans, SIPs, in reputable, well-managed mutual funds is a very sensible approach.
Why SIPs specifically?
Because they allow for rupee cost averaging. You invest a fixed amount regularly, so you buy more units when prices are low and fewer when they're high. It smooths out the entry point and avoids the stress of trying to time the market perfectly, which is, nearly impossible.
So discipline and consistency over trying to be a market timing genius.
Precisely. It's a more sustainable approach for most investors.
Okay, what about the overall mix? How should people think about allocating their money?
Asset allocation is crucial. A commonly suggested guideline, though it depends on individual risk tolerance and goals, might be something like 60% in equity for growth, maybe 30% in debt for stability and income, and perhaps 10% in gold, which can sometimes act as a hedge during uncertainty. It's about finding a balance.
Right, 60, 30, 10. A balanced approach. Yeah. Got it. Now, what about those smaller stocks, the ones that sometimes shoot up really fast but might be riskier? Any advice there?
Yeah, caution is generally advised with smaller stocks that show extremely high valuations. Specifically, if you see a PE ratio above 30, that should probably raise a flag.
Why the caution?
While the potential returns might look tempting, these stocks often come with much higher volatility and risk. They can fall just as quickly as they rise. Sticking with quality, as we said, is often safer, especially in a market with already elevated valuations overall.
Okay, that makes sense. Stick to quality, invest systematically via SIPs, maintain a balanced portfolio, and be wary of those really high-flying, high PE, smaller stocks. Anything else folks should keep in mind?
Absolutely. Stay informed. It sounds basic, but it's vital. Keep an eye on global economic news,
Like the U.S. Fed you mentioned.
especially developments related to the U.S. Federal Reserve. Their interest rate decisions and policy signals have ripple effects across the globe, very much including India. Being aware of those potential shifts is important.
Okay, great advice. So let's just quickly recap this deep dive. The Sensex hitting 82,000, quite a moment.
Definitely.
Driven recently by that positive India-U.S. trade news, strong FII and SEP flows, stable inflation, and breaking a key technical level.
Right.
Long-term picture shows incredible growth, but also resilience through past crises.
Mm-hmm.
But looking ahead, while India's growth is a plus, we need to be mindful of those elevated PE ratios around 23, 24, and keep an eye on global risks like U.S. interest rates.
There.
Sector-wise, IT looks strong, maybe getting pricey. Banking might offer relative value. FMCG seems a bit slower for now.
That's the current picture, yes.
And the strategy advice. Focus on quality companies with low debt. Use SIPs for consistent investing. Maintain a balanced 60-30-10 kind of asset allocation. Be cautious with smaller stocks having PEs over 30. And crucially, stay informed about global trends, especially the Fed.
That sums it up well. It's about navigating this environment with awareness, focusing on fundamentals and a sound strategy, not just chasing the latest headlines.
So for you listening, and this 82,000 mark is certainly a significant point. Hopefully the insights we've discussed today give you some food for thought as you consider your own financial situation and plans.
Yeah, it's a good time to reassess.
It really makes you think, doesn't it? With the market at these levels, what role do you want to play? Is this the moment to perhaps look more seriously at those investment options you've been putting off now that you have a clearer sense of the forces shaping the market? Definitely something to mull